Imagine a Fortune 500 company loses $5 million on a random Tuesday morning. Production costs spike, margins collapse, the cash is gone. But the executive team sitting in the boardroom won't actually realize it happened until next week. The culprit here is traditional manual accounting. Relying on human data entry means relying on retroactive information. By the time an analyst actually tallies the invoices and matches the inventory, the company is reacting to a financial autopsy instead of a live pulse. This delay creates a massive blind spot known as cost distortion. When you allocate overhead costs like facility power or management salaries using outdated historical volume metrics, you end up slapping the wrong price tag on your own products. The margin of error is staggering. Relying on these traditional allocation methods can warp your true operational costs by up to 35%. If your accounting ledger is just a look at what died last month, rather than a live radar of what is happening right now, you are flying blind and bleeding cash. That cost distortion trickles directly down to the bottom line. When your internal data is wrong, you accidentally misprice your inventory, eating the losses before the product even hits the market. This chart illustrates how devastating that can be. Look at the massive red bar. Companies using traditional costing suffer a 28% decrease in profit margins. But when those firms switch to digital methods, the profit bleed vanishes, dropping the loss to just 5%. This next chart shows the ripple effects. The large blue bar indicates a 12% variance in production costs under traditional methods, making budgeting nearly impossible. But when digital costing is implemented, that chaotic variance plummets to a predictable 5%, restoring operational stability. These metrics suggest that a company's survival depends less on the product itself and more on the ledger's ability to accurately reflect the cost of making it. The solution to this data lag is robotic process automation, or RPA, working alongside artificial intelligence. Collectively, this is known as digital costing. Instead of waiting for paper invoices to clear, the AI simultaneously connects the factory floor, the supplier's inventory, and live market pricing into a single continuous neural network. This flowchart shows how the architecture operates in practice. Raw transaction data flows continuously from the ERP database layer, gets automatically cleansed, and is fed straight into the machine learning layer for live analytics. Because the system learns cost behaviors over time, its forecasting is remarkably precise. This graph tracks those predictions. Notice how tightly the dotted orange predicted cost line hugs the solid blue actual cost line. The AI anticipates reality almost perfectly. This automation eliminates the old 24-hour human reporting cycle. Now, the AI flags cost anomalies and pricing discrepancies in under 3 seconds. This automation shifts the ERP system from a passive historical log into an active profit protection engine. Curious tone. Once you automate your accounting, you generate an enormous amount of structured live data, and that digital exhaust is now so valuable it can actually be monetized. This academic paper introduces a framework called the Extended Asset Recognition Model. It proposes that internally generated digital data is so critical to modern enterprise value, it should be officially counted as an intangible asset on a company's balance sheet. To actually house and protect an asset of this scale requires immense cloud computing architecture. And to ensure the integrity of a massive data pool processed by AI, companies are increasingly looking to blockchain technology for immutable record keeping. The algorithm builds a completely new class of wealth out of thin air by cataloging these insights and turning raw data into reportable assets. The obvious question is what this means for the human accounting team. These digital employees do not exist to fire the finance department. They exist to free them from tedious, rules-based data entry. When the bots handle the math, the human accountants are elevated to strategic roles. They spend their time running complex what-is simulations, testing scenarios, and mapping out the overarching business strategy. We can measure the exact financial reward of this human and AI symbiosis. Companies making this transition see a proven 25% improvement in their return on investment. Delegating the ledger to a robot allows the human mind to focus entirely on growth, building an enterprise capable of pivoting in real time. Look at this timeline of cost management solutions. We have permanently moved past traditional cost categories and into the era of advanced cognitive automation. The potential for exponential cost reduction is entirely driven by digital solutions. Modern business survival requires knowing your exact operational costs right this very second. Waiting until the end of the month is a luxury no one can afford. Any company still relying on human beings to perform the retroactive work of a digital bot is actively engineering its own failure. In the digital economy, real-time cost transparency is the baseline for survival.